Right. Sorry. Good morning, everyone. Welcome back to the day three. Sorry, this is day four. Okay. Uh, Again, my voice is not improved. So please bear with me. So, first off, I'm very happy to hear that uh, you all are finding value in this. Thank you for some feedback also. Based on that feedback, I am making certain changes on for today's session. So the feedback we received was that we would like, or you would like rather, more solving of questions. So what I've done is instead of two questions, we'll do three questions today, so that within the given time we are able to complete it. Right. Um, So, those of you who are new, I am Paritosh Panchal, and we have been doing a revision session for financial management for ACCA December attempt. And the first day we have done the exam tips and tricks, and second day we did working capital management theory plus two questions. Day three, we did business finance, some theory with some questions. And today is day four, wherein we will be discussing questions only. We won't be doing much theory. Questions. And in these questions, there would be some theory. So we will eventually discuss a little bit of theory, um, but not basically getting into a teaching mode right now. We'll just be solving questions relating to investment appraisal. So these are the three guaranteed topics on which you will get a Section C question, that is investment appraisal, working capital, and business finance. Right? So without any further ado, let's begin. So as usual, we'll first read the requirements. We are required to, I hope the screen is visible. Let me just check. Yeah, it seems proper. Um, what is the requirement? Discuss the difference between risk and uncertainty in relation to investment appraisal. So risk, as we know, see, usually risk and uncertainty is used interchangeably, but risk, as we know, we can quantify it, we can attach probabilities to it. Whereas in case of uncertainty, we cannot attach probabilities, we cannot quantify it. Okay, that's the minor difference between the two. Then it's just for 3 marks, so you can write it in brief. Around 3, 4 sentences should be adequate. Um, Calculate the expected net present value of the investment project and comment on its financial acceptability and on the risk evaluate relating to the variable cost. So we have to calculate NPV and something else also, comment on the financial acceptability and something relating to variable cost. We have to discuss certain risk relating to it. We'll find out as we read more about the question. It's for 9 marks. Then critically discuss how risk can be considered in investment appraisal process. So how do we consider risk? We can consider risk with the help of a risk adjusted discounting rate. Okay, we can consider risk by applying probabilities and finding the expected value or the expected NPV. We could do something like a sensitivity analysis to understand that what is this project sensitive to. So these certain steps, and I think you could do like yeah. So these are the things that you could discuss about. So it's for 8 marks. So you could probably discuss around four different methods in which you could consider risk in your investment appraisal process and then explain it with 2, 3 sentences each. Right. So yeah, at least we now know we have to do NPV calculations and something relating to variable cost. So with that intention, let us read the question. Vixen Vixen company is evaluating a planned investment in a new product costing $20 million. So you can immediately write down in a financial summary $20 million. So investment required $20 million. Payable at the start of the first year of operation. So in year zero, it's an outflow. The product. So the moment you realize that it's a NPV based question, the format of NPV should come in mind. That we first take sales minus costs, okay, taxes, tax savings on TAD, then your capital expenditure, your scrap value, your working capital expenditure, all of that. Then cash flows, then use the NPV formula and get your answer, right? So yeah, we have the initial investment of $20 million, and the product will be produced for 4 years. So it's a 4-year project, at the end of which the production will cease. The investment project will have a terminal value of zero. That means there doesn't seem to be any scrap value. Financial information relating to investment project is as follows. So we have been given sales volume. So this is the units produced in a year, or rather sold in a year. We have the selling price. We have fixed costs. Fixed costs, if you can see, it's not per unit. It is fixed. These selling prices have not been adjusted for selling price inflation, which is expected to be 3.5% per year. So every year inflation increases by 3.5%. The annual, so basically these rates, we need to inflate it by 3.5%. Okay. Now we'll discuss how to do it shortly. Right now we are just reading the question. But just keep in mind, in fact, you could note this down that 3.5% is the inflation. So we noted this. This is a simple copy paste that I have done. I haven't written the entire table again, just a quick copy paste. And selling price inflation 3.5%. I wrote that down as well. Variable cost per unit depends upon whether the competition is maintained between the suppliers of the components. The purchase department has made the following forecasts. So if the competition is strong, the variable cost will be 10.8, and the probability of a strong competition is 45%. Probability of a moderate competition is 35%, and variable cost will be 12. And the probability of a weak competition is 20%, and the variable cost in that case will be 14.7. Okay, so there are different scenarios given to us. So we have to find the expected variable cost. Okay, so it's nothing that 45% into 10.8, 35% into 12, 20% into 4.7, add all of them up. That's your expected variable cost. And with that, you can proceed. Okay, keep in mind, these are not uh, different years. It's relating to the same year. It's only that whether the competition is strong, moderate, or weak. Based on that, the variable cost would vary. If the competition is strong, vendors would try to price it aggressively so that they are able to make the sale. They are able to attract the sale better. Okay, just a moment. Is it better now? Now? Yeah. Okay. Thank you for pointing that out. Okay. The variable costs in this forecast are therefore being taken being before taking account of variable costs of inflation, 4% per year. So you need to inflate, once you find the variable cost, you need to inflate it by 4% every year. Vixen can claim tax allowable depreciation on 20%, 25% for per year, reducing balance basis on full investment amount of 20 million, and pays corporate tax of 28% 1 year in arrear. Okay. So keep in mind taxes are paid 1 year in arrear, which means that there will be a 1 year delay or a lag, okay, in the taxes that you pay. And always keep in mind, we don't use depreciation per se or tax allowable depreciation per se. since it is non-cash in nature, so we do not consider it. However, we do have to consider the savings in tax due to depreciation, because tax allowable depreciation, as the word suggests, is tax allowable. That depreciation will reduce your profit. Since your profit reduces, you will have to pay less taxes. Similar concept of interest. Interest was tax allowable expense. Similarly, depreciation is a tax allowable expense. Just like in interest, we used to take post-tax cost of debt. Similarly, you are going to take the tax benefit over here. Okay, what is the benefit? How much less tax are we paying? Because there is depreciation, and that depreciation has reduced profits, and therefore we pay less taxes, right? So we need to find the tax savings on tax allowable depreciation. Do not stop at 25% of the uh, asset value. Okay. Do not stop at tax allowable depreciation. It is savings on tax allowable depreciation, right? It is planned to finance the investment project with an issue of 8% loan notes. So we are going to arrange for this 20 million with 8% loan notes, which are redeemable in 10 years' time. Vixen has a nominal after-tax WACC of 10%, a real after-tax WACC of 7%, and a cost of equity of 11%. So here they have given us everything. All right. We have to select which rate we shall use. Okay. See, first off, do we take 8%? Some would say that the project is being financed only by a loan of 8%. Okay. But understand this, we always assume that it is being funded from a pool of funds, and you need not actually even assume it. If you look at it, the project life is just 4 years, whereas the loan is for 10 years. So clearly, that loan is not only going to fund this project, but other things as well, because it's a 10-year loan, right? So we won't use 8% as the discounting rate. We need to take WACC. Now we have two WACCs available. So since we are not taking cost of debt individually, we are not going to use cost of equity individually as a discounting rate. Okay. So our discounting rate will be cost of capital. Okay. Now, which cost of capital or which WACC? Okay, WACC is nothing but your cost of capital, weighted average cost of capital, right? So we have nominal after tax WACC and we have real after tax WACC. Okay. Nominal means already inflation is built into it. Real means it is without inflation. Always remember, real rates will be less than nominal rates. And typically, the rates we have in the markets are always nominal. From nominal rates, if you remove the effect of inflation, you arrive at real rate. Then there is a formula for it. Okay, it's not minus, it is multiplication. Okay, nominal rate is equal to real rate into inflation, or 1 plus real rate into 1 plus inflation rate, right? So if you want to find the real rate, you will divide nominal rate, 1 plus nominal rate divided by 1 plus inflation rate. Anyways, coming back to the question. So we need to decide whether we should take 10% that is nominal or 7% that is real. That depends on your cash flows. Are your cash flows real or nominal? Now, currently, your cash flows are real in the sense that they have said that sales has been given to you and they are saying sales inflation is 3.5%, variable cost has been given to you, variable cost inflation rate is 4%. That means there is specific inflation rates given to you. There is no general. And as we know, or as we have studied, that whenever we have specific inflation rate, that is more than one inflation rate, we always have to use nominal interest rates, sorry, nominal cost of capital. Okay, we cannot use the real method, therefore we cannot use the real WACC or real cost of capital. Why? Because real WACC is inflated or is removing inflation of the general inflation rate. Okay, so we don't know that general, and it doesn't apply because your specific inflation rates are applying. So what you will do, you will inflate the cash flows, okay, arrive at nominal cash flows and discount these nominal cash flows with nominal interest rates or nominal cost of capital. Okay, so we are going to follow the nominal method of discounting over here. Okay, so let's begin. All this information, our financial summary that we have made over here. So first off, you can start off making the pro forma of the NPV. So we can write our initial investment. In fact, I would recommend having the initial investment later after you are done with taxes. Okay. Initial investment, then you will write scrap value. Now, scrap we discussed is zero, so there is no scrap value over here. Okay, there is no working capital either, so scrap and working capital is ignored. Okay. Initial investment is there, so $20 million. Now, if you can see, I have written it completely, so there is no confusion whatsoever. I'm not writing it as 20, I am writing it complete as $20 million. Okay, so $20 million, year zero. And then sales, we are mentioning now sales has been given to us. If you see, selling price is given and sales volume is given. Okay, so direct sales is not given. We have sales volume, we have selling price. We can just multiply the two and get our sales. However, okay, there is inflation, correct? Okay, so see how the disclosures are made. Working note number one, calculating sales. Very crisp, clear headings have been given. In fact, over here you can write sales are from WN1. Okay, so year 1, 2, 3, 4. We have the sales volume from the question. We have the selling price from the question. Now we need to inflate it. Okay. Now remember that when we are inflating for 1 year, it will be raised to 1. When we are inflating for 2 years, it will be raised to 2. When we are inflating for 3 years, it will be raised to 3. And for 4, raised to 4. Why are we doing raised to 1, raised to 2, raised to 3, raised to 4? Because the inflation rate is not literally 3.5% every year, because if inflation for year 1 is 3.5%, then for year 2 it is on 3.5%, there is further inflation. Okay, so it is 3.5 into another 3.5%, or 1 plus, it's 1 plus this into 3.5% further. Okay, so on and so forth. So this is nothing but 1 plus 3.5% raised to, okay, sorry, it will be into 1 plus, yeah, okay. So, and then since it's year 3, so it's 3 years of inflation happening. Okay, so it's literally this, or I could just take this into 1 plus 5%, and so on and so forth. Okay, that is how it is growing. I can just do minus 1 to get the actual. To 7.12%. It's raised by 7.12%. Okay, so this is how inflation is done. Another way which is very typical. They will just give you sales as on year one is, so for example, okay, if they have given you this sales, okay, basically this has been given in the question, that sales is equal to $12 million, wait, okay, $12 million, and inflation is 3.5. Subsequent inflation is 3.5%. So what you will do, this into 3.5%. Okay. Sorry. Wait, let me just see if the screen is. Yeah. Wait. Yeah. Sorry, it would be 1 plus. You just keep forgetting that 1 plus. Okay. So you would say this raised to put this in bracket. Okay. So, oh no, sorry. Okay, it would be like this then, right? So then, see over here, your selling price is changing. Okay. But if you were just given total sales and they have said that it's increasing by 3.5%, then you would take the previous year's sale, add 3.5 to it. Then you will take the previous year's sale and then add 3.5 to it, and so on and so forth. Okay. Over there, you need not take raised to 2, raised to 3. Reason being, this is already inflated. So you're taking the previous value and inflating it further. So if you want to use a similar logic in this particular question, what you will do is you will take selling price per unit. Okay. Say, for example, 27.43 is given to you. All you have to do is this into 1 plus 3.5%. Okay. Just a moment. Oh, so here the thing is that the selling price is changing. Okay, it's not based as 26.5 only. Every year the selling price keeps changing. Okay, so we can't really use this logic in this question. Okay, we are forced to do it this way only. Had the selling price been fixed at 26.5 and then been inflating at 3.5% every year, so you could have written that 26.5, like year 0, you would have written it this way. Year 0, you would say year 0, the selling price is 26.5. So then from year 1 onwards, you are applying inflation into 1 plus 3.5%. Okay. And this is the other way of doing it, wherein you are taking the previous year as the base and no need to do raise to, you can just proceed. But over here, this is not the case. Selling price keeps changing. It's not fixed at 26.5, and it's not only inflation that is increasing the selling price. Selling price happens to increase on its own as well. Okay, wait, before I proceed, let me just show you the formula of this. So I'm doing previous selling price into the inflation rate, into the inflation rate, previous into the inflation rate, so on and so forth. Okay. But over here, as we discussed, we cannot use that method. Reason being, our selling prices keep changing every year from 26.5 to 28.5 to 30 to 26. So individually, you will have to inflate it. Since you are inflating it individually, you will do raised to 1, raised to 2, raised to 3, raised to 4. Okay, these are two ways in which inflations are done, or rather, depending on what the case is, two ways how to approach inflation. Okay, now that we have inflated individual prices, we just multiply the units into the price and we arrive at the, I was just checking, so we arrive at the sales, right? So this will become our sales over here. Okay, if you see, these are our sales. Now, variable cost. Now, for variable cost, again, they have given us three scenarios. You can just do the probability into variable cost. So Px, right? And then add all of it up. So this is nothing but multiplication of the two. And then you add all of it up to get at expected variable cost. So you are expecting variable cost to be $12, right? And variable cost inflation is 4%. So over here, oh, I spend a lot of time explaining that same thing over which we are going to do over here. So over here, what you could do is, now it's up to you. Either you can write it this way, or we could follow our other method, that is inflated variable cost can also be, this is just an alternative. Okay, let me just write alternative. Okay, inflated variable cost. We know it is $12 into 1 plus 4%. Okay. Then I'm going to fix this 1 plus 4% because inflation rate doesn't change, right? So 12.48. Then I can just do this into 1 plus 4%. Okay, or I could just manually write 1 plus 4%, then I need not lock it. All right, so you see, without doing raise to, okay, just by taking the previous value, I am able to get the same answer. Over here, we have taken the base and then raised to 1, raised to 2, raised to 3, raised to 4. Okay, this is the raising happening over here. Right, so two ways in which you could calculate that inflated variable cost. Once you find that, it's just cost per unit into the units sold, right? So you can just multiply the two, get your answer over there. Very simple. Okay, so you see how else you could have calculated variable cost. So once variable cost is calculated, put it in your answer. Okay, fixed cost is given in the question directly. So you could just, in fact, reference it out of here. Okay. So fixed cost, and then you have your profits, which is nothing but sales minus all your cost. Okay. That is why I prefer doing initial investment after taxes, because profits will only consider these values. Tax will also only consider this. So if you see, tax is 28% of the profit since it is 1 year delay. See, normally what you will do is you will do it this way. Okay, this into this into this. At 28% of the profit. But there is a 1 year lag, so you are shifting the entire thing with 1 year. Okay. Why is this not working? Yeah. All right. So you are shifting the whole thing by 1 year. right? So this is pretty simple, 28% of the profit in the previous year. So therefore, we stretch it till year five, though it's a 4-year project only. Then tax savings on depreciation or tax allowable depreciation. So firstly, we need to calculate depreciation. So our next working note, tax savings on TAD. In fact, over here, we could just highlight these things. Okay, or I've written it in bold, but I think it's fine. Just written it in bold. So, if you want, you could put it in another, probably. Oh, no, that can't be right. I'll leave it. Basically, just highlighted that this is the final answer. Okay, similarly for sales also, this was the final figures that we have taken. Right, for TAD, we could write our tax savings, so we could make this as bold. These are the final figures that we are utilizing. So initial investment was $20 million, of which 25% is depreciation or TAD. Okay, so I'm reducing that amount over here. Wait just a moment. Okay, sorry. Yeah, so out of that, I am reducing 25% as depreciation. On this depreciation, I'm calculating tax 28%. Okay, so $5 million into 28%, okay, will be 1.4, but I want everything in $1 million, so I am multiplying. So these figures are in $1 million already. Okay, but tax are not in $1 million, it is just in dollars, so I have to write million over here clearly. The reason I'm doing it is so that I can directly take the values over here, or else I could have taken this and then done into million above. Either or works, right? So $1.4 million. Similarly, then, see, the way you could proceed with this is very simple. Okay, once you find this, all you have to do is 20 minus 5. Okay, 15. Then you can just do copy paste, and get your answer. Okay, very simple, right? I always remember in the last year, there will not be, so this is TAD for year, okay, as on year 2. Depreciation for year 3, so year 2. This is written down value as on year 3. Okay, so on and so forth, or as on end of year 1. I think that is a better way of writing it. Okay, actually, that should have, right? Oops. Right? So this is year 0, then year 1 depreciation, year 2 depreciation, year 3 depreciation. Year 4, there will not be any depreciation. Year 4, you are ending it. So you will say balancing allowance. Tax savings will be calculated on the balancing allowance and not in. You do not have to charge depreciation. Typically, there is a scrap value, but in this case, there is no scrap value. So scrap value is 0. In fact, you could write that. Okay. Scrap value is 0. So you could write So this is how you can do it. So balancing allowance would be 8.4375 million dollars. So into 28% into million. So you will get these many million is the balancing allowance or tax savings due to that. Okay, this and then you are saying it's 1 year in arrears. So since this is depreciation of year one, this will be depreciation. This will be as of year two. So we could write this as on end of year one. You need not write all these things for the exam. This I'm just writing it for your understanding purpose. Okay, this is year three. Therefore, there is a 1 year delay, becomes year four. Taxes are paid in arrears. So the benefit also you will get in arrears. Right? So all these TADs, you will put it up. Okay, tax savings on uh, tax allowable depreciation. Then net cash flow, nothing but add all the things up, all the relevant cash flows up. So in year zero, there's only initial investment. Year one onwards, it is profits less taxes plus any savings. Okay. So that way, everything is done. Right? Clear? And then you can use the NPV formula is equal to NPV bracket open. Now this what I'm using is spreadsheets. So Google spreadsheets, therefore it is giving me a guide that now you need to input the discounting rate. But in your answer, in your CBE platform, you will not get this guide. You should know the format is same. So is equal to NPV discount rate we saw was how much? We decided our discount rate will be nominal rate. Where is it? Yeah, it is nominal WACC is 10%. So is equal to 10%, 10%, comma, bracket open, select all cash flows except for year zero. You do not take year zero because it's already in present value terms. So you will take year one. So press shift, arrow, 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 close bracket. Okay. And then close the whole NPV formula. Then you will say less year zero. Okay. So you will get the same answer that we calculated earlier. Right? I hope the formula is clear. So is equal to NPV 10% bracket open, select all the cash flows, bracket close. So even if you do not put these cash flows in a bracket, it's fine. But yeah, this is how it is done. Okay, directly use the NPV. Do not waste your time finding individual discounting factor, then multiplying, then adding all of them up. It's time consuming. In the CBE platform, in your exam, you have the liberty to use the NPV functionality. So use it and save time, right? Get used to using NPV function. But you also need to know how to discount because for section A, section B, you will not have access to this formula, right? So if in section A or B, you have to do some NPV calculation, you need to know how to do discount. It's very simple. Discounting factor into the cash flow. Okay, is will give you present value. Find all the present value for different years and then add it all up. Right. So we can see that the NPV, which I've highlighted, is a $2.8 million. It's a positive figure. Therefore, we shall approve of it. However, this whole positive NPV is on an assumption or is on basis that variable cost is $12. So let us see in which scenarios variable cost is actually $12. So $10.8, we say it's less than that. That means no problem. If our cost is less, then our NPV will only be more. If it is exactly $12, no problem. But if it is 14.7, then our NPV will be lower. We don't know how much. Maybe it turns negative. We don't know. We haven't done the calculation. So we just mentioned that the probability that the variable cost will be $12 per unit or less than $12 per unit is 80%. How did we find it out? 45 plus 35 is equal to 80%. Okay, there are only 20% chance that it is more than $12. It is the 80% chance is less than $12. So since it is 80% chance that it's less than $12, so there is 80% chance that the positive NPV or the NPV will be positive. Okay, therefore, uh, uh, there is a 80% chance. As we said, there's a 80% chance that the NPV will be positive. Therefore, we shall accept the project. However, if a variable cost increases to 14.7, then we need to calculate it and we are writing that. So, however, the effect on NPV of the variable cost increasing to $14.7 per unit must be investigated as this may result in a negative NPV. We don't know. The expected NPV is positive, and so the investment project is likely to be accepted on financial grounds. We are calling it expected NPV because it's based on expected variable cost. So there is a 80% expectation on a probability that it will be $12 or less than that. Therefore, there's a 80% probability that NPV will be either 2.8 million or more than 2.8, but not less than that. 20% chance it will be less than that. Now, it could be negative. We don't know. We haven't calculated. If you want to find out, you need to calculate it. That's what our conclusion is like. Okay, so not a one line sentence. You have to write a small paragraph, 2, 3 lines behind it. Right. Moving on to the theory part. So, risk and uncertainty. Now, we have already discussed the theory. So, while we are reading the question, I've already discussed that risk is quantifiable, uncertainties are not quantifiable. Risk you can assign probabilities, uncertainty you cannot assign probabilities. Okay, so just read through it. You can take a pause, read the 3 paragraphs, then take a pause and read the last paragraph. The difference between risk and uncertainty, therefore, is that the risk can be quantified, whereas uncertainty cannot be quantified. Risk will increase with the variability of returns, whereas uncertainty will increase with project life. If the life of the project is 20 years, 30 years, there is uncertainty that maybe after 20 years, if the business shuts down, uncertainty is there. We can't assign a probability or what are the chances that after 20 years it will shut down the business. We can't really say. Okay, it's not measurable. On what basis are you going to measure or quantify it? Right? Whereas risk has to do with variability. That's why we say standard deviation, variance, beta is a measure of risk. They all measure variability. Okay. Then methods also we discuss. So there's sensitivity analysis. Just read through it. Pause the video, read through it. This is the whole thing of sensitivity analysis. For there's more. Okay. So sensitivity analysis basically that if one element moves and everything else remains constant, then what is the impact on NPV, right? And then you have probability analysis, stop and go through this, right? We kind of did probability analysis for variable cost over here in this chapter, sorry, in this question, but we haven't done it for the entire NPV, right? What are the chances that the NPV, or you would have like 3 scenarios. If the economy is doing great, the NPV is great. If the economy is doing okay, the NPV is okay. And if the economy is not doing great, okay, then NPV obviously won't be doing great. So you could find like an expected NPV also, right? So you can use probability analysis. Basically involves assigning probabilities. What is the percentage? What is the chance that economy will be great for the next 2 years? Okay, percentage. risk adjusted discount rate. So you are adjusting the discounting rate only for the risk. So in fact, the CAPM model takes, like, the base of CAPM model is beta, okay, which is a systematic risk measure of a systematic risk. So based on risk, a cost is arrived at using CAPM. Okay, so you can use that CAPM model and ascertain risk and therefore ascertain WACC as per that. Okay, now keep in mind that if your business risk is changing, okay, along with your financial risk, your business risk is also changing. Say, for example, you were manufacturing t-shirts and then all of a sudden you started manufacturing watches, right, or perfumes. Different business, different risk, therefore different asset beta, different proxy beta. Since different asset beta, then you apply your gearing to it and you will get a new equity beta also, which is what we use, right? So read through this. And then lastly, adjusted payback period. So see, normally, now, as we read earlier that or discussed earlier, that risk has to do with uh, sorry, risk has to do with variability, whereas uncertainty has to do with time. Okay, but when risk and uncertainty is the same, like, you try to believe it's the same thing or it's very similar, in such cases you could use something like adjusted payback period. Though it's a period, you would say that I would prefer projects which has a shorter payback period. Why? Because it's less uncertainty. After 30 years, who knows what can happen? But at least in the next 3 years, I know that there's a very low probability that the business will shut down. Okay, so that is adjusted payback period. You can read through it. And yeah, with this, we are done with question one. Let's take a quick 5 minutes break and I'll see you again with question number two. Right? 5 minutes break. Quick. Hello, welcome back. Sorry, there was some net connectivity issues, so there was some delay. Um, I don't know how many minutes have passed, but it's definitely more than 5. Extremely sorry about that, but things we couldn't control. Anyways, moving on, question number 2. Um, I hope, wait, let me just check if everything is proper. Yeah, the net seems stable right now. Yeah, okay. So, question number 2. PLK company is considering investing in a new machinery as part of a launch of a new product, the Quago. The new machine is expected to have a useful life of 4 years and could be bought for $1 million, half of which would be paid immediately with the rest payable in a year's time. The scrap value. Okay, sorry. Before we should be reading the requirements first always. So calculate the following values of the proposed investment in the new machinery and comment upon your findings. So we are asked to find the NPV and the IRR. Then we are asked the strengths and weaknesses of IRR as a method of investment appraisal. Uh, so the strengths are that it takes into account discounted cash flow. That is, it takes into account time value of money. Another advantage, as we discussed in year day one, is it's a percentage, so it's easy to understand. Um, and then the weakness, it's a 5 mark question, so you could probably give like two points each in strengths and weakness, and 1 point you could just utilize to explain what IRR exactly is and how the decision rule under IRR would be. Okay, and so for weakness, you could then write that IRRs, there could be multiple IRRs of a project. Okay, that's one major weakness. And so, yeah, so like that, you could highlight the strengths and weaknesses. Um, some members of the board of PLK are wondering why ROC and payback period have not been considered as the investment proposal. Discuss the reason why net present values theoretically preferred to those to these other than other investment appraisal methods, right? So it is so there are certain members who feel that why have we left out ROC and payback? Why are we focusing only on NPV? So basically, the benefits of NPV we need to discuss over here. Okay, it's for 4 marks, so you could highlight 4 points. Again, not in points, but proper sentences. So 1 or 2 sentence per point, right? So now let's read. So there's a new machinery. New machine has a 4 year useful life, can be bought for $1 million, half of which would be paid immediately and rest in a year's time. So year zero outflow is 500,000. Year one outflow will be 500,000. You can also write this down. I'm not scrolling. I'm just saving on time. I'm not scrolling down, but you could put all of this as your financial summary, right? The scrap value of the machine after 4 years would be $30,000. The sales revenue and variable costs for Quago in each of the 4 years are expected to be as follows. Um, so scrap has been given 30,000. Now sales and variable costs are given over here. Sales value and variable costs and production and sales unit per year. Okay, this is not per unit cost. This is straight dollars. Okay, this should actually be written as dollars. Okay, these are units. So unlike the previous question that we did where we multiplied units into selling price per unit, here we do not need it because we have the sales directly given. We have to check if there is inflation or not. Fixed costs relating to the project will be $10 per unit. So, okay, so the units are used for fixed costs. It's $10 per unit. In the first year, the fixed cost is expected to remain unchanged in price terms throughout the project. So you just have to do $10 into 35,000. That is $350,000, and it will remain the same. There is no inflation expected. Producing and selling the cargo will mean increased investment in working capital. required, but this will be recovered at the end of the project. The requirement at the beginning of each year is as follows. So year 1, 2, 3, 4, the requirements are, this is the working capital required. Now understand this, that already in year 1 you have invested $100,000. In year 2 the requirement is $120,000. So you need to invest only $20,000 extra, not 120. Okay, so just 20,000. Then as on year 3 you require $150,000, but just a moment. Yeah. In year 3 you require 150, but as of year 2 you have already invested 120, 100 previously and then 20, so that makes it 120 total. So you need to invest another just $30,000. Then over here you require 110, so that is going to release $40,000. Okay, just the difference, 150 minus 110, $40,000 will get released. And then always remember, this is a common mistake. In year 5, working capital will get completely released. So we'll get this 110,000 of inflow in year 5. Okay, whether it's written, not written, you should always write it. Okay, and you can write, we assume that working capital gets released in year 5. A PLK company pays tax 1 year in arrears at an annual rate of 30% and can claim a TAD of 25%. So 25% of the asset, that will be your TAD into the tax rate, that will be the savings on TAD. The first claim for tax allowance on purchase cost will occur at the end of the first year and will relate to the full purchase cost of the machinery. So they are saying that though you are paying in parts, but for tax purposes, for depreciation purposes, you are going to take the full value of the asset. Balancing allowance is claimed at the end of the final year of operation. PLK uses a nominal after-tax cost of capital of 15%. So they have asked us to use the money rate or the nominal rate, not real rate, and makes sense. In fact, nothing about inflation has been given so far, and then the requirements come. So useful life 4 years, price of machine, how much we are paying today, how much we are paying by the next year, scrap value that we are going to receive, fixed costs, working capital is recovered at the end of the project. I think I missed that sentence, but even if it's not given, you write it. Tax is paid 1 year in arrears, TAD is 25%, nominal post tax is 15%. Okay, so year 0 now, as I've suggested, we will write year 0 at the end after all the taxes and everything is dealt with. So capital investment, uh, today we are paying 500, next year we are paying 500. Scrap value that gets released at the end of the project is $30,000. And investment in working capital, that it will be a part of a working note, so we'll write it later, we'll discuss it later. So first off, sales. Sales has been very clearly given in the question, so we can just take the values from the question. So these are your sales for 4 years. Okay. Variable cost, again, given in the question. So taken from your variable cost, right? Fixed cost, you need to calculate, it's $10 into the units. So $10 into the unit. Okay, and then subsequent years is going to remain same in an amount wise, so it remains as $350,000. So we calculate profit therefore, and then we calculate tax on those profits. It's in 1 year area, so there's a 1 year lag. Okay, 30%, 30%, 30%, right? Then savings on TAD, so that from our working note can calculate. So $1 million machine, as we said, the full value of the machine would be used for depreciation purpose. 25% in year 1, 25% in year 2, year 3, and year 4, that is end. There is no depreciation, but it is sold out at $30,000, and you have a written down value. Sorry, you have a balancing allowance. On balancing allowance, you will calculate savings on TAD. Okay, which is 30% of the amount. 1 year delay, so year 1's tax savings is reflected in year 2, and so on and so forth, right? So Where were we? Yeah, savings on TAD. So we write down our savings on TAD. Investments, scrap value. Now moving on to working capital. Working capital, as we discussed, what are the requirements? 100, 120, 150, 110. These are the requirements. So how much do we have to invest? We have to invest 100,000 today. Then for next year, we need 120. So we invest 120. We invest only 20 as on year one because we have already have 100,000 investment inside the system. We need to pump in another 20, another 30. 40 gets released, 110 gets eventually released at the end of the project. Okay. So these working capitals we have written from the working note. You could in fact write it also, investment in working capital, working note number 3, or whatever working note it is. Then you arrive at your total cash flows. NPV is equal to NPV, bracket open, 15% is the discounting rate. Select all cash flows from year one only. We will not take year zero. So shift, arrow, 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 selecting all of them together, bracket close, minus, adjust for your zero. So this is already in minus, so I'm just writing a plus sign and then this, okay, 55,684, right? So to conclude, given the above estimates, the NPV of the proposed project is negative. Therefore, we recommend not going ahead with the project and reject it. Okay, then they also asked us to find the IRR. Very simple, is equal to IRR, bracket open, select all the cash flow, including year zero. Okay, in NPV, we do not select year zero in the formula, but for IRR, we select all cash flows, including year zero. So we can just, wait, let me just do it again, is equal to IRR, bracket open, go here, shift, arrow, 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 arrow. Okay, 12.1%. So the decision rule for IRR is you compare IRR with cost of capital, that is your discounting rate. So if your returns, internal rate of return is higher than the cost, okay, then you will accept it. But in this case, you can see that IRR is lesser than the cost of 15%. So we shall reject it. So both NPV and IRR methods suggest that the project should not be executed and should be rejected. Right? So conclusion, given the above estimates, IRR is 12.1%. Is less than the project WACC of 15%. Therefore, we recommend not going ahead with the project. A project is financially viable only if IRR is greater than the cost of capital. Right? Now, moving on to the theory part, theory answers. They have asked us about the strengths and weaknesses of IRR. So, write a little bit about IRR. Okay. You can probably relate IRR to this particular case also. Then we highlight the strengths of IRR, that IRR and NPV takes time value of money and considers all the future incremental cash flow. The main advantage of IRR is that it is easy to understand because it's a relative measure, it's a percentage, especially for non-financial managers. So therefore, it is widely used and it's easy to calculate using a spreadsheet. The weakness is IRR method ignores the relative size of investment. Okay, for example, if so, they made a point and now they are explaining it. For example, the IRR for a 50 million, $50 project. Okay, if the investment is 100,000, just $100, and the return is $50, then the IRR would be same as if the project investment is $10,000 and the IRR is 5,000. Okay, it is the same. Right. So that is the weakness of IRR. So you cannot really compare two different projects because the size of one project would be like $1 million and the return would be in millions. Okay, but as a percentage, it would be same as if it is a smaller project of just $1,000 investment, right? And when discount rates are expected to differ over a life of the project, there can be these can be incorporated easily into NPV calculation, but not IRR. So in case if there are situations where differing discounting rates are to be used, then IRR cannot uh, it cannot be easily incorporated into IRR. Okay, so these are the two weaknesses they have highlighted. You could highlight anything else also, but just explain it. Then they asked why NPV is better, like in a different manner. Basically, they asked that why didn't we use ROCE and payback period? So we give the advantages that NPV have over ROCE. So over ROCE, well, NPV is not relying on counting profits; it's based on cash flows. And why is cash flow better? Or why is accounting profits not good? We can highlight that. Then from we compare NPV with payback period. So why is NPV better than the payback period? Payback period does not consider the entire period, does not consider time value of money, which NPV considers. So about that. Then another point, NPV incorporates time value of money, which ROCE doesn't. NPV reflects the value of investment rather than the measure of return and represents the theoretical change in total. This is the major advantage of NPV, that it kind of measures the increase in shareholders' wealth. It gives you an idea with regards to the increase in shareholders' wealth, which is the primary financial objective of managers, right? So you could highlight these. So we have highlighted 4 points, 2 marks each. We are writing a few lines about it. Okay, two lines each, and we score our 8 marks. So if you see, in fact, all like even the last 2 days, you would have observed that calculation is actually 50% or even less, right? More weightage is given on theory. And this is on day one, I suggested do not ignore theory. And this is how you can also study theory by just reading through the theory answers of all these questions. What I suggested back then also, and typing it down. So your typing speed also improves, your presentation skills improve. Okay, how to highlight something, how to make a text bold, you know how to do all those things. That is why it is very crucial to type it on the CBE platform, right? Let's move on to the next question. Before we read, let's read the requirements first. Determine whether ASOP should lease or buy the new technology. So it's a 10-mark question over here. And then discuss the difference between nominal approach and real-time approach for NPV. So now nominal and real I've already explained in question one, so I'm not going to explain it again. Um, like in case of real approach, you are going to take real cash flows and discount it using real rate used when you have general inflation rate. Moment you have specific, and if you have taxation involved, you will suggest using nominal rates and or nominal approach wherein you are taking nominal discounting rate and using inflated cash flows, that is nominal cash flows, and discounting those at the nominal rate. Okay. Only when you have, like, if you have specific, go for it. That's the only option you have. Nominal. When you have specific inflation, you cannot use real. If you have general, you can select nominal or real. Whatever method you pick, you need to be consistent, right? That is, if nominal cash flows, nominal discount rate. If real cash flows, real discounting rate. The end. Then discuss how an optimal investment schedule can be formulated when capital is rationed and investment projects are either divisible or non-divisible. Okay, capital rationing we have done in our classes. Basically, you have fixed amount, okay, and that fixed amount, how much you will allocate using with the help of PIs. Now you have divisible, that is, you can either divide the project, that is, you can do half of a project or a 75% of a project, that is divisible, and non-divisible is either you do 100% of the project or you don't do anything of the project, right? So that's your divisible and non-divisible. So again, two theories, one calculation, 10-mark calculation, 10 marks theory. Right now, calculation is it's a lease versus buy, something that is ignored by a lot of students. Question 1 and 2 are your typical NPV based questions, wherein you are to calculate, like your typical investment appraisal questions, wherein you are asked NPV, you are asked IRR, you are asked payback period, ROC, all of those things. Okay, this is one question which belongs to the same topic, investment appraisal, but is talking about lease and buy, which a lot of students ignore, and that is precisely the reason why I've included this particular question. In fact, in your latest exam kit, this question no longer is there. I don't know for what reason they have removed it. But in the older exam kits, this question used to be there. Okay, so you'll find it over there. And I think this has come in one of the pre-mocks as well, one of the past pre-mock papers. Okay, I think I picked it up from there. So anyways, let's read. ASOP company is considering an investment in new technology that will reduce operating costs through increasing energy efficiency and decreasing pollution. The new technology will cost $1 million and have a 4-year life, at the end of which it will have a scrap value of $100,000. Okay, so you could write all again our financial summary. So the cost is $1 million to purchase this technology. It's a 4-year life, and at the end it will have a scrap value of 100,000. So if you are buying it, the buying price is 1 million, and since you own the asset, when you sell it you get $100,000 as scrap. But a license fee of 104,000 is payable at the end of first year. This license fee will increase by 4% per year in each subsequent year. If ASOP bought the new technology, it would finance the purchase through a 4-year loan, paying interest at an annual before tax rate of 8.6% per year. Okay, so they have given interest that we need to pay. This is before tax, pre-tax, 8.6%. Okay. Alternatively, ASOP could lease the new technology. The company would pay 4 incremental lease rental of $380,000 per year, payable in advance at the start of each year. The annual lease rental would include the license fee. So you need not pay the license fee separately. If you own the asset, you have to pay a license fee separately. So it's like, say, for example, you buy your software, or sorry, buy a computer. Okay. Within the computer, you have different softwares. So, initially the softwares are just trial versions. Then, if you want to continue using that software, say, for example, Microsoft Office, if you plan on continue using Microsoft Office, you may have to pay some fee for it, a subscription fee for it, or an antivirus is there with your new laptop. But if you want to use it beyond a year, then you have to pay a subscription fee annually. So this is what a license fee is. The technology, the machinery is the hardware. Then you need a license fee to use it, the software part of it. Okay, but if you lease it, it comes with the software. Okay, that is 380,000 includes everything. If ASOP buys the new technology, it can claim tax allowable depreciation on the investment on a 25% reducing balance basis. The company pays taxation 1 year in arrear at an annual rate. Now, just keep in mind that the lease that we are paying is in advance at the beginning of the year, and the license fee is paid at the end of the year. Okay. So yeah, we wrote all these things down. Now we just have to compare the two scenarios, that whether we are profitable in, like, see, both are outflows. Okay, we don't know the inflows, and we do not need the inflow, because whether you lease or you buy the asset, the revenue that you are going to generate is going to be the same, right? If you run a restaurant from an owned property versus you running a restaurant from a rented property, the sales will be the same. Sales does not get impacted. What changes is the cost, because if there is rent, you have to pay rent. If you are owning it, you have to purchase it. Like, there's an initial outflow, then there's depreciation. Okay, all of that. So let us look at only outflows. In fact, nothing is given about inflows, and we don't require it. Let's take the easy one first, that if it is lease, then we just have to pay $380,000 per year in advance. Okay. So if it is a lease, So you are paying in advance 380, right? So year 0 onwards, we are paying at the beginning of the year, right? And the tax savings on lease, now understand that it is 1 year in arrear. Okay. Now, what is happening is this year 0, okay, is basically the beginning of year 1, and this year 1 is nothing but the end of year 1. Okay, this is basically, you can say, end of year 0, beginning of year 1. Okay, this is end of T0, start of T1. Okay, this 1 is basically end of year 1, start of year, end of year 1, start of year 2. Okay, so understand this, that taxes are paid at the end of year 1 typically. Okay, typically you will write taxes as like this. Okay, you will write it as if it is end of year 1. Now, end of year 1, okay, what was the expense you incurred was this at the beginning of year 1, 380. This is at the beginning of year 2, right? So there, this 114 will relate to the previous year or the beginning, whatever amount was there. But taxes are paid in arrears, so you are shifting it again. So there is a double shift. Okay, getting it? Right? So just keep that. This is the only tricky bit over here. Since it was at the beginning of the year, it starts on year 0. And then this would have ideally, tax will never start at the beginning of the year, right? Tax will always be at the end of the year. So tax will always start from year 1, but this is with a lag. So it starts from year 2. So keep that in mind, right? And then you get your total cash flow. See, lease is an expense. Expense will reduce profit. Profits are reduced. You will pay less tax. Therefore, there's tax savings due to that expense. So we are just calculating how much is that. So 30% is the tax rate. 30% of the expense is 114,000. That is the benefit. But we'll get the benefit only in year 2. Okay, year 2 onwards rather, for 4 years. There's an outflow for 4 years, so you will get benefits also for 4 years, right? So you get your total cash flow, and then you just have to find the present value. In fact, this is not even the net present value. You can call it the present value of all expenses. Okay, present value of expense at 6% discounting rate. So you can just use the direct NPV formula, NPV, bracket open, 6%, bracket, comma, select your 1 onwards cash flow, shift, arrow, bracket close, and then you take your 0 also. Okay, so it becomes $102,000. Sorry, $1 million. Okay, so NPV in case of leasing is, or the cash flow in case of leasing is an outflow of $1 million. If you are to buy it, then initially you purchase, like there is an outflow as on year 0 of $1 million. There's a scrap that you will get at the end of the project. Okay, that is $100,000. There is a license fee, right? A license fee of $104,000 that we have to pay every year, right? Since we are purchasing it, and it is paid, this fee is paid at the end of the year. So at the end of year 1. So this is proper for us, right? License fee is paid. Now tax savings on this license fee. So we are 1 year arrear. So we are calculating this tax savings on that license fee. And there is also tax savings on depreciation. Okay, so there are two tax savings. So TAD, you already know the format. right? Put in, and at the end there is scrap, and on the balancing amount we'll do it. There's a 1 year delay, so year one, the savings benefit will arise in year two, right? So where was I? Yeah. So remember, there are two tax effects that you will have to give. One for the expense, because there is no profit. See, in the regular question, we normally do sales minus all the costs and then find profit. And on profit, we do tax paid, we used to do over there. And then we used to take tax savings on TAD. Over here, there is just one expense. So on expense, you are just calculating tax saving and then you are doing tax savings on TAD. So there are two tax savings over here. So keep that in mind. Many times students will, out of habit, will just do this and will ignore this. Though they may have taken tax savings over here, or sometimes they would have forgotten that taking tax savings over here only. They'll just say, oh, lease is paid. But you would know that tax savings is there if you have practiced any question, any question from leasing versus buying. Okay, the tricky part over here is only the year part. Okay, that's the tricky part. Yeah, then you have your tax saving, you find out all your cash flows, you find the NPV using the formula is equal to NPV 6%, select all year one onwards cash flow, and then adjust for year zero, which is already in present value. Okay, and then you find out it's less than $1 million outflow. So you will say go ahead with buying. Okay, given the above estimates, we recommend buying the new technology because the outflow is lower. Okay, with that, we are done for the day. Thank you so much for your time. I hope, just like the previous three sessions, this session also added value, was helpful. I tried to pick questions which would benefit you to the maximum. I hope you got to learn something new. Thank you so much for your time. All the very best for your exam. God bless you all. If you have any doubts or questions, you can ask in the comment below. My team will reach out to you. If you want the presentation, not the presentation, as in if you want this spreadsheet, reach out to them. They will send it to you. Okay.